For most of human history, money was not a government invention. It emerged from trade. People converged on goods that were saleable across time and space. Shells, salt, cattle, then metals. Gold won because it was hard to produce, easy to verify, divisible, durable, and portable. That is sound money, a store of value that does not depend on anyone's promise. Central banking changed the rules. Instead of money backed by scarce assets, modern states issue fiat currency, legal tender backed by law, not by redemption into gold. Central banks can expand the supply. When they do, each unit buys less. Inflation is not a mysterious force. It is the dilution of purchasing power by monetary expansion. The Bitcoin standard, by economist Safedian Amos, argues that this system has predictable costs. Easy money lowers the cost of borrowing today and shifts the bill to the future. It rewards debt over savings. It distorts investment. Capital flows toward projects that look profitable only because interest rates are artificially low. And it raises time preference. When money loses value, people prefer consumption now over building for later. Hard money does the opposite. When saving is rewarded, people plan longer horizons. Civilizations built on sound money, think the gold standard era, saw capital accumulate, prices stabilize, and trade expand. When money is debased, the reverse happens: short-term thinking, boom-bust cycles, and a slow erosion of middle-class savings. Bitcoin enters this story as a new kind of hard money. It is not backed by a commodity in a vault. It is backed by mathematics and energy. The supply schedule is fixed, 21 million coins, with new issuance having roughly every 4 years. No committee can print more. No government can seize the ledger. Verification is open, anyone can run a node and check the rules. That design targets the properties sound money needs. Scarcity is enforced by consensus, not by trust in a central issuer. Divisibility is built in, each Bitcoin splits into 100 million satoshis. Portability is native to a global network. Durability is digital replication across thousands of nodes. And hardness, the difficulty of increasing supply, rises over time as mining competition intensifies. The comparison to gold is instructive. Gold's stock-to-flow ratio, existing supply divided by annual production, is high because mining adds little to the stock. Bitcoin's stock-to-flow was designed to mimic and eventually exceed that hardness. After each halving, the flow of new coins shrinks while the stock grows. Holders face decreasing inflation by protocol, not by policy. Central banks exist partly to manage the trade-off between stability and flexibility. Lenders of last resort, inflation targets, employment mandates, all assume money can be managed. The Bitcoin standard challenges that assumption. If money is a technology for coordinating economic activity across time, then neutral, predictable money may outperform discretionary management. Volatility in the short term does not negate the long-term thesis: a fixed supply asset cannot be inflated away to fund deficits. This is not an argument that Bitcoin replaces every function of banking overnight. Payment layers, credit markets, and institutions still matter. Lightning Network, for example, builds instant settlement on top of Bitcoin's base layer, but the anchor remains the same scarce asset. The base layer provides the settlement guarantee, second layers handle scale. For builders and investors, the framework is practical. Ask what happens to your cash reserves over a decade of monetary expansion. Ask whether your treasury should hold assets with verifiable scarcity. Ask whether machine-to-machine commerce, agents paying for APIs, data, compute, needs a neutral settlement layer that no single platform controls. Bitcoin is often discussed as speculation. In the Bitcoin standard, it is presented as infrastructure, a decentralized alternative to central banking's monopoly on money creation. The book's closing implication is cultural as much as technical. Money shapes behavior. Sound money encourages production, saving, and long-range cooperation. Unsound money encourages consumption, leverage, and political short-termism. Whether Bitcoin fully succeeds as global hard money is an open question. What is not open is the mechanism: fixed supply, open verification, censorship-resistant transfer. That is a standard worth understanding, whether you adopt it or simply need to explain why others are building on it.